Hello, we are University of Minnesota Duluth, Team 2. We'd like to thank everybody in attendance today, and we're here to tell you why lifetime shares are ready to lift. So you better get ready to pick some up and hold on to them for a lifetime. We are issuing a buy recommendation on lifetime group holdings based on their ability to grow free cash flow into the future. This led us to a $34 price target, representing a 28% upside from yesterday's closing price. Now, I'm going to pass it on to Carter to go over our business overview.
Lifetime is positioned as a capital-light premium fitness giant, and we have conviction in their ability to execute on their high-margin flywheel. The business is anchored in almost 900,000 memberships in 189 different locations, targeting specifically the affluent member that drives average revenue per membership to $3.5 thousand. This demographic not only ensures high engagement, multiple spending touchpoints, but high operating leverage that is continuously reinvested into the company for compound growth. Next, I'll pass it back to Trevor to go over industry analysis.
Lifetime operates in the health and fitness industry, which is a large yet very fragmented industry. The 5 key subsectors that we've identified are the at-home fitness providers, low-cost gyms, mid-market gyms, boutique fitness clubs, and lastly, the premium fitness clubs. Lifetime operates in the premium fitness club subsector, offering a broad range of amenities and high-end services. They target the affluent consumer and drive long-term retention through a true lifestyle-oriented experience. In our view, Equinox represents Lifetime's most direct premium competitor, while more value-oriented chains such as LA Fitness remain viable alternatives. Should consumer preferences shift because members are not typically locked into long-term contracts, switching between clubs and even subsectors remains relatively easy. With that, I'll pass it off to Tyren to go through our investment summary.
We strongly believe that Lifetime is set for success because of its improving operational efficiency, which will fuel future value creation. It is sustainably building more centers than ever before, and its member utilization will continue to increase. These key catalysts make Lifetime Fitness a free cash flow machine. Next, I will hand it off to Blake to further discuss our first catalyst.
Our first catalyst is improving operational efficiency. Operational efficiency is driving stronger margins, better cash flow, and a healthier balance sheet. Shifting to an asset-light model, monetizing real estate through sale-leasebacks, and reinvesting capital into growth has significantly increased cash conversion while maintaining operating control. As newer clubs mature, margins expand, cash flow becomes more predictable, and leverage continues to decline, we believe Lifetime is set up to create long-term economic value. Now, I'll have Carter go over our second catalyst.
Our second catalyst is accelerating new center growth. We strongly believe in the expansion model as new centers scale to an average ROIC of 30%, with EBITDA margins scaling to 30 to 35% after a 3 to 4 year ramp period. With 12 to 14 expected new centers opening per year and a 12% forecasted revenue CAGR, we believe Lifetime is well positioned to capture its remaining addressable market. Next, I'll pass it back to Blake to go over our third catalyst.
Our third catalyst is increasing center utilization. Lifetime is benefiting from a higher member utilization, with membership visits rising at a 10% CAGR since 2020, combined with a 25.5% CAGR in-center revenue during the same period. Growth in these ancillary offerings like pickleball and dynamic personal training are increasing monetizable touchpoints, supporting pricing power and sustained revenue growth. Next, I'll pass it on to Trevor to discuss competitive positioning.
Beginning on the left, we show Lifetime's current club footprint relative to the total market capacity across the major metros. Expansion opportunities remain strongest in established markets such as Los Angeles, New York, and San Francisco, while a large amount of key untapped white space remain in areas such as San Jose, the Inland Empire, and even Orlando. Shifting to the right, we evaluated brand perception. Because Equinox and LA Fitness are private with very limited disclosure, we developed a proprietary research methodology by analyzing Reddit sentiment across all 3 brands. By developing a Python script to scrape comments tied to each name, we built a differentiated view around consumer sentiment. Lifetime shows the strongest overall sentiment, especially around pricing power and amenities, reinforcing its premium positioning. With that, I'll pass it off to Brandon to go through our financials.
Taking a look at the financials, as Lifetime continues its asset-light expansion and we see our three key catalysts continue to play out, this will result in continued ROIC expansion, marking sustainable value creation after 2026. Lifetime currently returns invested capital at a rate of 6.5%. 5 years from now, we expect this rate to pump up to a staggering 11.9%, which is significantly higher than the company's weighted average cost of capital at 7.7%. Another key financial focal point is the continued gains in free cash flow. In 2024, the company was free cash flow positive for the first time since its IPO in 2021, a true testament to the success of the asset-light business model. As a result of operating leverage and this unique business model, we see free cash flow significantly outpacing revenue growth into the future. Not only will free cash flow continue to grow at unprecedented rates, but it will be in better shape than ever before as the company converts more of its EBITDA to free cash flow. Now, I'm going to pass it to Tyren to tell you how this impacts our valuation.
100% of our valuation comes from our free cash flow to the firm DCF, where we arrived at a $34 price target representing a 28% upside, based on a 7.7% WACC and a 2.25% terminal growth rate. We made sure to stress test our assumptions with sensitivity as well as bear and bull case analysis. Our valuation provides differentiated insight into Lifetime's underlying economics. We primarily used a lease-adjusted free cash flow to the firm DCF, where we capitalized operating leases, treating the lease expense as financing to better reflect the economic performance and to neutralize capital structure. We then cross-checked with a free cash flow to equity DCF, where we included sale leasebacks as a part of net borrowings to maintain that consistency. Both approaches converge on the same equity value per share, which reinforces our conviction in our price target. Next, I will hand it off to Carter to discuss ESG.
Lifetime's management reinforces our thesis through a track record of execution and risk control. They have scaled the renewable energy share from 7% in 2021 to now 25% in 2024, all while slashing emission intensities from 6.8 to now 2.7. Our proprietary ESG scorecard also indicated that Lifetime is in line with peers like Vail Resorts and Planet Fitness. Overall, ESG does not pose any structural risk to the company or valuation overhang, as the company's profile reflects stable and comparable practices to its own sector. Our conviction in management comes from founder and CEO Brahm Akrati, as he maintains a 7% ownership in the company at a tenure of 33 years. These interests are further aligned as 90% of his compensation is variable and tied specifically to EBITDA targets. Additionally, 10 out of 13 board members remain independent with an average tenure of 9 years. This ensures disciplined oversight of the company's long-term strategy. Now I'll pass it to Blake to go over our risks.
No matter how great an investment thesis is, there's always going to be some risk associated with it. The first risk we identified is a potential increase in cap rates driven by higher interest rates or a downgrade in Lifetime's credit profile, affecting their effectiveness in the sale-leaseback market. The second risk is changing consumer preferences around consumer ancillary offerings, putting downward pressure on margin. And the final risk is the threat AI presents to middle managers, a demographic likely affecting the company's total addressable market. Now I'll hand it to Trevor to re-rack the weight.
To reiterate our price target of $34, representing a 28% upside, we view Lifetime Fitness as a prime buying opportunity due to our three key catalysts: improving operational efficiency, accelerating new center growth, and increasing center utilization. We strongly believe that the fundamentals are in shape, the growth story has strong endurance, and the valuation has plenty of room to flex. We would like to thank the CFA Society for allowing us to be here today, and with that, we would love to open the floor up for any questions.
Could you talk in a little bit more detail when you talk about operating efficiency, maybe that term gets thrown around a lot. What does that actually mean?
I guess what I would say to that is just the expansion of their margins, which is largely driven by their pricing power. They have a large way to improve how much or increase the amount that they're charging, and especially considering their affluent member base. And with their new expansion model, it's building a lot more efficient centers, which will naturally improve their efficiency within their operations and have larger margins both through the operating as well all the way down to the net income.
Yeah, expanding a little bit more on that, the new centers they build are largely attributable to their price increases in the recent years. As they build new, more premium centers in these higher income MSAs, it inherently increases the amount they're able to charge, which is reflected in the margins.
And when you talked about utilization, did you arrive at any assumptions on what is a saturation point, right? At what point does someone, what's the maximum number of visits people can expect? They don't go every day. $3,500 out of pocket. What's a stress point on that? And then members. What's a saturation point on members per club? Did you try to break that down to help rebuild your revenue model and talk about utilization?
Yes, I did. Blake, can you go to our ARPCM model slide? So, starting with your first question on visits per member, we believe it's reasonable to assume 160 visits per year is where it begins to cap out. I mean, realistically, that's a visit every other day, and if they're targeting a high utilization member base, I think that's a fair assumption. You also talk about members per center. I believe it was 47, close to 5,000 members per center, and I don't believe that is unreasonable at all. These are huge centers. We're talking anywhere from 80,000 to 90,000 square feet per center with tons of equipment for everybody to use. This isn't your typical gym. You're going to be able to go there without it feeling crowded, even with a large member base. And Blake, can you please flip to our slide about, I believe it's the affluent consumer slide. Perfect. So, as you can see behind me here, the more income one makes, the less of their income is going towards fitness-related spending, which means a company like Lifetime can target affluent consumers and continue to raise prices without facing too much price sensitivity. Although we do not know the exact point in which a consumer will stop paying the prices, we did taper off their growth of their membership pricing or their membership dues. It starts off around 10%, then tapers to 9%, and by the year 2030, it's about 7.5%.
I thought I saw a slide of your EBIT margin was pretty flat for the foreseeable future, but your EBITDA margin is going all the way to 30%. How did you guys arrive at that?
I would say that there's sort of two separate things that are going on here. The first is the overall firm-wide EBIT and EBITDA margin, whereas separately it's for the new centers. So when we were referencing the 30 to 35% EBITDA number, that was directly for those new centers, which also goes back to the first question and how they're able to drive operational efficiency, is that they're building more sustainable and more efficient centers. And that's coming from just automatically having a lot of that built in. And that comes in with one of the risk too, in which if there's a new change in member base, one of the things that Lifetime is able to do is they're able to pivot like they've done with Pilates and especially with pickleball. But one of those things that happens is those margins compress slightly on their already built centers. But then when they are building these new centers, they already know to include a pickleball court and a Pilates studio. And so there's automatically slightly better margins for that.
Okay, good answer. But I thought your target markets are San Francisco, LA, New York. I thought, did you guys factor into the cost of running those operations? Because obviously those are high rents, high cost of labor as well. So I'm just curious, and it's pretty competitive in those markets as well, right?
Within those markets, we didn't necessarily factor in the cost of the real estate there, but you can also fairly assume that your members are making more money in those cities, as they're high cost of living cities with high paying jobs, allowing these members to make up the difference in the dues they pay.
Guys, I always think it's interesting to talk about personal biases when we're investing. One of the central pillars of what you're talking about is that people are going to be willing to pay considerably more money for their gym memberships, right? I'm just curious if you thought at all about the fact that you are young men probably at the peak of gym usage through your lifetime, and also people who probably have mom and dad paying for that gym membership.
Can you go to our demographics slide showing their demographics right now, please, Blake? When it comes to demographics, the average member makes, or the average household per each membership belongs to, makes about $160,000 per year. This provides a lot of flexibility. Not only that, but 60% are couples or families. These aren't kids going to the gym. And the way they structure their membership structure allows for, say, a parent to pay the big fee while adding on additional members of the family for cheaper. This is why they have such a strong value proposition in these markets.
Can you talk to me a little bit about how this intersects with topics like K-shaped economy, affordability, rise of AI, and how that might affect the kind of people who you're going after?
Yes, wonderful question. As we've seen recently, the K-shaped economy has shown these affluent consumers are willing to keep spending. They're still spending on leisure, they're still spending on everything they once had, while your less fortunate consumers are cutting spending, only shopping at low-cost stores such as Walmart. And luckily, that's not who these guys target. They're targeting affluent consumers who are doing exceptionally well in today's economy.
Let me just ask, though, when we talk about K-shaped economy, are we talking about people who make $160,000 a year across two incomes? Or are we talking about people who have a net worth that's got 2 commas?
I guess I'm not 100% sure on the specifics here, but this is over 1.4 times the median household income in the United States. I believe it's somewhere around the top 80% of earners here. I would say that belongs in the top spending side of the K-shaped economy.
Yeah, I haven't noted that your bear case price target was right around where the market is pricing this currently. So I guess I assume or interpret that as, the market is valuing this as the bear case right now, or what is the market missing? Help me reconcile the two.
Blake, can you flip to our bear case, please? So, a slight mistake on our part. We did forget to update one number in our entire slideshow, and our real bear case represents a $24 downside, which is lower than today's, and I believe it's still a fair bear case, even if it was to come out to $27, which is about what it's going for today. Our bear case is based on higher cap rates, which could come from a sudden increase in interest rates, Lifetime itself getting a credit downgrade, which in the long term reduces the amount of new centers they're able to open. And as we know, new centers fuel their margins, and they also make up almost 40% of their revenue growth every year, which ultimately leads to lower free cash flow in the long run and lowering the intrinsic valuation, coming to a $24 price target.
Just one quick last one. Did you arrive at a terminal population of facilities? Like, where does the number of facilities top out for Lifetime?
Yes, we did. Blake, can you please go to our key TAM findings?
34.
Anyways, we assume that they can build out anywhere from 121 to 186 new centers. 121 is a more reasonable assumption as it excludes saturated markets where their top competitor, Equinox, competes. So these are the blank white space markets that Trevor talked about earlier.